joined us and you haven't had a chance yet, the lines are open. Go ahead, say your name and let us know what city that you're calling from.
Yeah, my name is Ed Mahoney, and I'm calling from Chevy Chase, Maryland.
Hi, Ed from Chevy Chase. Welcome to the call, Ed.
Thank you.
Who else is out there today?
My name is Robert Jones. I'm from Washington, D.C.
Hey, Robert from Washington. Welcome to the call.
Thank you.
You're welcome. Who else we got? I see the lines are filling up fast.
This is Mike from City Beach.
Mike, welcome to the call.
Thanks.
Who else?
Mark Schauber from Manassas.
Hey, Mark from Manassas. Welcome to the call.
Brian O'Bill from Washington, D.C.
From Washington, D.C., welcome. And again, welcome to our conference call hosted by Sullivan Company, CPAs. Our topic today is the top 13 mistakes made by retirement plan investors. And before we get started, I want to cover a few housekeeping items. First, you should have received the note sheet when you registered for the call, and a link to download it was also sent in the reminder email. We suggest that you have that printed out and in front of you so that you can use it to take notes during the call. Second, as we go through the top 13 retirement mistakes, the phone lines will be muted, but if you have a question, we'd like for you to do two things. One is go ahead, write your question down on your note sheet so you don't forget it, and then two, press *2. That's *2 on your phone. This will sort of raise your hand on the phone and let us know that you have a question. Then we will open up the phone lines after covering the 13 retirement mistakes, and you can ask that or any other questions you might have. And if you are not already a client, Sullivan & Company CPAs is an accounting firm in the Bethesda, Maryland, Washington, D.C. area that provides a broad range of services for business owners, executives, and independent professionals. And on the call today, we have a panel format with several people that I'll introduce. We have Paul Sullivan, CPA and President of Sullivan & Company, Kathy Groh, Enrolled Agent and Investment Advisor Representative, Bill Isaac, CPA and our Tax Department Manager, Dan Fannin, our Business Service Manager, and Raj Goenka, one of our Senior Staff Accountants. So with everyone here, let's go ahead and get started. Paul and Kathy, welcome to the call.
Thanks.
Thank you.
Hi, I'm going to start out, and I'm going to keep you on track during this seminar with your note sheet and give you the answers to the fill-in-the-blanks, and that should keep everybody on the same page. So let's start with mistake number one. Mistake number one is thinking that the 401k is a free account. Of course, it's not a free account. Nothing's free. Our experience is that oftentimes in the hustle to get your 401k account set up and choose your investments, the cost of the account is lost. Most 401k plans and simple plans and SEPs are invested in mutual funds, which have fees associated with them. The one that's more commonly understood is the sales load. That's the A, B, or C share. You probably have at least heard it or seen it from time to time. These are commissions paid to the representative for selling you the investment. Different share classes do make sense for different circumstances, but the percentage charged is typically no less than 1% per year. The next fee is the 12B1 fees. These pay for the fund's advertising. How often you see them on TV might give you an idea of whether this is a lot or a little. Typically, they are between 0.25% and 1% per year. The third is an annual expense fee, which goes to the person or persons who manage the fund. These vary a lot. They can be substantial. Last is the portfolio turnover fee. This is not in every 401k, but it can be a fee that adds up. This is a fee anytime there's a sale or a buy. If you were wondering why you weren't aware of these fees, it's because they're paid out before they reach your account. These reduce your earnings. A wise investor will want to know how much he is paying, recognizing that there needs to be some cost, but there's no need to line someone else's pockets if you don't have to. Does the panel have some comments on this?
I mean, the examples I've seen over the last 30 years include myself. of about 15 or 20 years ago. But most owners, when the plan is set up, they don't understand how the fees are paid, and since it doesn't come out of their account, they really don't ask about it. And if they do ask, the person many times merely says the mutual funds pay them, so they're not aware of what the costs are. My recommendation would always be, if you're talking to one of these people, you should say, show me in writing how I am paying you and how much. Then you can get a gauge on what you're paying. We've seen pension plans for companies many times, besides the fees that she mentioned, the package includes annuities or some insurance products that are paid out of the pension plans, and these add to the cost too, and many times the business owner doesn't understand why they were purchased, but they were put in the package. As part of what we do, we've looked at our clients' pension plans, and we analyze what their fees are compared to the people we're affiliated with, Archer, and many times come up with a difference of between 1/2 and 1.5% more that they're paying. And this business structure they have, which is a financial advisor, which is commission-based versus fee-based, which we are, and there also are a lot of other fee-based planners, the cost is typically less, and it's more straightforward because the fee is paid out of the person's account, so they can actually see it. But my experience is you need to compare it on the front end, and otherwise you realize you're paying more than you thought you were.
Right. All right. Mistake number 2 is not having a written, proven investment strategy. This is referring to an investment policy statement. A lot of people don't have one, so I'm just going to give you an overview of what it is. An investment policy statement is a statement that defines general investment goals and objectives. Okay, that's things like, you want to retire at 56. It describes the strategies that will be used to meet these objectives and contains specific information on subjects such as asset allocation, risk tolerance, and liquidity requirements. You can write one yourself, but oftentimes it's done with an advisor, and it sets the ground rules for both you and the advisor for how you're going to handle your investments for the long term. It's not the same as a financial plan because a financial plan includes insurance and your principal residence and other types of assets. The IPS, the investment policy statement, only deals with the investing. It's written so that you can go back to it perhaps annually to see if it's on target and to also see if there's anything that's changed which should cause your strategy to change. Let me give you an example. Let's say that a person is 26 and they're an employee making $60,000 a year. They still have school debt, but they're determined that they can start saving for retirement. The IPS would include the fact that short-term goals like paying off the school loan and buying a house will take much of their discretionary money. The IPS would include a specific long-term savings amount or a percentage of income. There'd be an asset allocation of maybe 4 asset classes, and the risk tolerance would be there and how often you want to monitor your progress. By the time the person is 45, he owns his own business and his income is much greater. At this point, his IPS will have changed to include more asset classes and a required amount to invest money in order to reach his long-term goals. And so you can kind of see the difference. When you don't have a lot of discretionary money, you're limited in what's in your IPS. But as your income gets higher and you can have more flexibility, your advisor is going to help you determine how much needs to be invested. So the advisor is there to help the investor understand the external influences and to monitor the investments, helping you measure your progress. Does the panel have any experiences with IPSs that they'd like to talk about?
Our experience is I've seen an awful lot of very good certified financial planners or fee-based planners that do a very good job at this. They structure where you are according to your age. They calculate using the computer program. You actually have a written plan on, what you're going to save each month, the amount that's going to go out for tuition or whatever your expenditures are, and what's going to be left at retirement. And that exercise is not typically done by many representatives of some stock brokerage houses, but many of the financial planners do it as part of their work, and it gives you a blueprint for your life that you can track and change annually, and it's typically done at an annual meeting.
Very, very, very important aspect of the planning process. Okay, mistake number 3, not having a systematic formula to determine what type of funds to buy. Dan is going to discuss this common mistake.
Yeah, there's many things to look at and to think about here. Keep this in mind. Many 401k companies today only offer between 5 and 30 choices for your 401k. But it can take anywhere from 6 to 10 asset classes and 8 to 15 investments to properly diversify your portfolio. Most 401k plans just do not offer enough choices. So even if you invested an equal percentage into each asset class, chances are you still would not be diversified. Now, that's something that's going to be unique to every company, but it's important to know that diversification and having a systematic formula to determine the types of funds to buy is a huge thing to focus on, and a mistake that many people make by failing to do so. So out of like 10,000 investment options available, the investor is usually working with about 5 to 30 choices in their plan. Most 401k investors choose the funds in their plan based on past performances or tips from fellow employees, maybe sales materials that the record keeper of the 401k sends out. Unfortunately, this kind of ends up in an asset allocation disaster. So it's important to realize that you need that formula to not only determine the types of funds to buy, but the types of funds to buy based on your goals and based on your risk tolerance. Also realize that the company that handles your 401k is getting paid based on fees they charge your employer and the annual expenses paid by participants like yourself. They make money whether you succeed or fail. If you're still an active employee, don't expect much help from the firm that handles your 401k. Chances are they will probably not even contact you until you retire or change jobs. Probably because at that point, that's where you can fire them. Panel, have anything to add to this?
Yeah, I think all of us have had this experience. But one of the things that we want to emphasize is that, excuse me, it isn't necessarily how many things are offered, but the quality and the appropriateness of what's being offered. So if you've got a good 401k plan, it may also have, 30 or 40 choices, but the difference would be that the advisor would be actually sitting down with you and helping you put together a portfolio that includes the asset classes that you need. Okay.
One of the
Go ahead.
I have a comment. One of the problems we see is the business owner hires the 401k person and they kind of deal with the owner freely. But the employees, it's another story. So if you're an owner and you want to offer benefit to your employees, make sure the person you're dealing with is talking to your employees and getting them in the right place. Otherwise, they get lost and they don't have someone to talk to. We looked at one recently, and the employee had been in the plan for 5 years, and all of the allocation was in the money market account. And there are reasons for that. If someone doesn't want to risk the market or risk other investments, there's a reason for that. But it tends to be that what happened was the person was just ignored and didn't know enough to see the representative and didn't know enough to select what was needed for their 401k. So if it's going to be a benefit, you have to offer some education to the employees.
Okay, mistake number 4, investing while looking in the rear view mirror. Raj is going to talk about this, and then we can discuss it a little.
Hello, everyone. Good afternoon, and thanks, Kathy. In my view, one of the most common mistakes made by investors is investing in a fund that performed well in the past, the ones that we call the hot funds. The hot funds are funds that did very well last year, but they might not do as well this year. Sometimes it seems logical to invest in those funds when you see how well they did, but this is by far the easiest way to lose money in the market. For example, if we go back to the 80s and 90s or any recent years, we see that the funds that did really well in those times had a downfall follow immediately. Some people may have made money in the beginning years when the funds were appreciating, but people who bought after the funds peaked will be lucky to stay even. I have a real example for this. If we look at American high income funds, these funds gained 48% in 2009. So many bought it in 2010. It actually had a good year, gaining 14% in 2010. But if you look at its history, it was down 28% in 2008. And so far in 2011, it's still down. So it's important to see whether a fund is appropriate for you and for a retirement account. This fund is invested in high-risk bonds and will probably continue to be volatile. So how would you know about this? You talk to an investment advisor, and they will guide you through it. Does the panel have anything to add to?
I had an experience of my own doing exactly this thing in the 80s, I suppose it was. Microsoft was getting higher and higher and higher, and it just, was just taking off. So my husband and I took a little bit of money and bought some Microsoft, and of course, it's never been that high since. And so at this point, we hold on to it, hoping that maybe it'll be something our grandchildren can get some benefit from. But it's exactly what Raj was describing. It's looking at something that was doing well, but that momentum does not continue.
My comment would be, if it was this easy, you wouldn't need financial advisors. If it was just as easy as picking a fund that looked good, it's just too easy to be able to be successful.
Mistake number 5 is overlapping investments. What does it mean to overlap in your retirement plan? Bill, I'm going to talk about this.
Yeah, thank you. Have you ever wondered why your account may stay flat or even go down, and you may even own 4, 5, or 6 different mutual funds? And one of the reasons could be that your investments are too correlated to one another. And what this means is that in the 4, 5, or 6 mutual funds that you own, they could all be investing in basically the same stocks. So what's basically happening here is that you have no diversification. So really the point behind asset allocation is that by spreading the money in your portfolio around, when some areas will do well and when others are not. An example of this, someone looked into the investments of the Magellan Fund and the S&P 500 Index Fund, and they found that they invested in basically the same investments. About 98% of their investments were exactly the same. But really one of the big differences here was that the Magellan Fund cost 3 times as much. So we have, the special software and tools which will allow us to gauge the overlap of investments inside your account. Therefore, we can make sure you're not doubling up on exposure to certain areas of the market. We have seen some of this also in our clients' 401k plans, where they are being offered investments like Putnam New Opportunities, Oppenheimer Capital Appreciation, and T. Rowe Price Growth. And basically, these three funds invest in this same four stocks, basically, or four stocks make up most of their investments in Apple, Google, Qualcomm, and Oracle. Does the panel have anything else to add to this?
I mean, I would say the most common item that happens when people have a 401k is they meet with the representative and they pick between 3 and 5 funds. There's no analysis of what is overlapping. In addition, if you look at those 3 or 4 years later, you see the people still putting in the same 3 or 4 funds. So the investments in those mutual funds might have changed and you might have overlapping, but nobody is looking at it for the employees.
Which leads us to mistake number 6, and that's the lack of professional support. By now you may be thinking that it would be helpful to have a professional work with you. And before we get into how do you know if you've got a good one, Paul led into something that is very important, and that is that most 401k plans keep the same investment from the day they started to the day they end. No one is looking at them for you, and if you're looking at them, you don't know what to do about them. You don't know how to analyze them, and most importantly, because you might be bright enough to read all of the information that's necessary, but you don't have the time, and that's where the professional is there for you. So how do you know if you've got a good one? Here's some tips. Have you heard from the advisor who set up your account in the last 2 or 3 years? Has anyone reviewed how your account is invested and given you their opinion? Do you hear from your broker, but it always seems like he has something new to sell you? Does he use load funds, those A, B, and C funds, and annuities to fill your needs? Does he have quotas to meet? We recommend that you work with independent advisors. Use your CPA, a chartered financial analyst, or a fee-based certified financial planner in order to assure objectivity. Years ago, I actually met a client who was investing with a large wirehouse. His losses were in the hundreds of thousands, and not because his portfolio was so huge that was a small loss. It really was criminal management, and a lawsuit did ensue from the different clients of the rep. The wirehouse had the advisor declared incompetent, and therefore they assumed no liability for his actions. So you really do need to know your advisor and what their core values are and how they operate. Any other comments?
I mean, my question regarding number 6 would be, can you do it yourself? And my assessment of that would be you can, but it's hard. And the reason it's hard is because, number 1, you have a job. And number 2, probably this is not your field, and you're in another industry. Number 3, this is your retirement plan. It's kind of not something you want to take risks with. If you want to have a side fund where you want to buy individual stocks, I don't see a problem with that. But this is your retirement plan, which should have an educated person managing it. Your situation, number 4, your situation and the situation in the market is going to change. And it's going to change annually from the changes in your life, and those need to be addressed, and the plan needs to be changed. And the last reason is March of 2009. If you remember, in March of 2009, people had investment accounts that had $600,000 in it, and they went to $400,000.
Right.
They kind of need somebody to talk to. The smart people stayed in. The S&P 500 was about 700 in March of 2009, and right now it's about 1150, 1200. So it has almost doubled. But we had clients that they got nervous, they didn't know what to do, They thought this was a one-time event. They just didn't feel comfortable at all, and part of the reason why they didn't feel comfortable is because they went into investments without understanding the risk. And the risk is when you invest in certain investments, equities, more than bonds, you're at risk. And if you don't understand that, then your asset allocation will be tilted too much into things where the risk that you took is not warranted. We give everybody a risk tolerance test, and we send it to the Archer funds, and they assess where they should be, rather than some type of conversation with a securities person, and based on what they discuss, they decide to go into aggressive, which ends up being not the place to be because they can't handle that.
Okay, and we'll get into some of those topics again. But now we're at mistake number 7, asset allocation train wreck for 401k plans. So the missing word is allocation. Bill is going to explain what's meant by this.
Okay, with the asset allocation, establishing an appropriate asset mix is a process, and it plays a key role in determining your portfolio's overall risk and return. So as such, your portfolio's asset mix should reflect your goals at any point in time. With that, asset allocation involves dividing an investment portfolio among different asset categories, such as U.S. stocks or foreign stocks, high-yield funds, or real estate, just to name a few. The process of determining the mix of assets that your portfolio will hold is very personal. It's a personal one to you. The asset allocation that works best for you at any given point in time in your life will depend largely on your time horizon and your ability to tolerate risk. By including asset categories with investment returns that move up and down under different market conditions within a portfolio, an investor can protect it against significant losses. So historically, the returns of 5, 6, or 7 major asset categories have not moved up and down at the same time. Market conditions that cause one asset category to do well often cause another asset category to have an average or poor returns. So by investing in more than one asset category, you'll reduce the risk that you'll lose money, and your portfolio's overall investment returns will have a smoother ride. If one asset category's investment return falls, you'll be in a position to counteract your losses in that asset category with a better investment returns in another asset category. Does the panel have anything more to add to this?
Bill, the accounts that I see over and over again are the 401ks of folks who have been at multiple jobs during the early part of their career. They chose growth funds because they were young and the advisor didn't educate them on why asset allocation would help stabilize their portfolio. So, now they're, 55 or 60 years old and the results are mediocre. And they're mediocre because there was no asset allocation. The other investor that I've seen that is a train wreck is the one who is only invested in their employer's stock. For example, United Airlines. I tried to convince a retired pilot that all his investments were all in one basket, and that was not a wise thing to do. But he was so loyal to United, and so what happened. He stuck with United, and there's been trouble, and then they had their bankruptcy in 2002. So asset allocation is extremely important, and a lot of people are just not aware of it.
Sometimes with account balances under $100,000, it's difficult to get all these categories, and it would be difficult to change them and balance them where they should be. So a solution we offer, if you go to the archerfunds.com, there's 5 managed portfolios, which allows people to diversify and have it actively managed. And in that way, you don't need to pick these categories yourself, which is kind of difficult, really, for anybody for a account that's not north of 500,000.
That's right. Yeah, if you can get into balanced portfolios that are managed in your 401k, that's a wonderful thing. Mistake number 8: moving your 401k to a salesperson and not a trusted fee-based advisor. If you're still employed and you're contributing to a 401k, you don't have the ability to move it at this point. If you're contributing to a simple, you might be able to, and it's something that we could talk to you about. So this mistake of having a salesperson and not a trusted fee-based advisor is for your old 401k or your investment portfolio. How do you find an investment advisor who you can be confident in? As we mentioned before, the designations such as CPA, CFA, or CFP are a good start. Look for someone who is fee-based rather than commission-based. It's generally an indication of less expenses to pay, and for someone who is advising you independently on your investments. Independent firms are generally more objective than firms connected to a brand, and you definitely want someone who is interested in your big picture, not just the one account or two accounts. Remember that you want your accounts to be in line with your goals. And so one of the things that we wanted to point out to you is don't judge the person on how smoothly he talks. Remember, salespeople are generally very good at talk. What you want to look for is substance and what he talks about with you. I'm sure you've got an example on this, Paul.
Wow, we have a lot of experience with this because probably during my career, first 10, 15 years, these people market to us wanting to get in on our client base. And I made the mistake of actually thinking they know what they're doing, and they don't. So we referred to some of these people, and it was the wrong thing to do. And the reason is because they did not have a technical understanding of what they were doing. Don't get me wrong, there are people that work for some of these places, and if they have a designation of CFP, you should pay attention to that. But unless they have some type of higher education, they are selling financial services now, but a year ago they sold mortgages, and we had one that called on me, and we referred a few clients to, but then after 2 years he left and he went to sell skyboxes. So you can see the continuity. You really got to have somebody that's going to be with you long term and is interested in your situation, and that you've done some background check on.
Very, very, very important. Okay, mistake number 9, staying in your 401k when you have the option of moving it to an IRA. Once you're no longer employed by a company, that retirement account should be moved to an IRA. Well, why? They don't make you. They don't send you a letter saying, please move your account because you don't work here anymore. The first reason, and it might be obvious, is that the advisor working with your former employer no longer has an incentive to be interested in your account, if they did. So if your account is $250,000 or more, they might be interested in you, and they might be in communication with you. But there are other reasons why you should move it to an IRA. There are restrictions on your 401k that don't exist in an IRA. When can you withdraw from your 401k? Oftentimes it's age 65, and this does vary from plan to plan, but oftentimes it's age 65, whereas an IRA, you can start withdrawing at 59.5 if you want. There are possibly fees that you're paying to keep that 401k account open that could be avoided in the IRA. There are also some creative beneficiary options with the IRA depending on your circumstances. So this is just touching on a little bit of why it's important not to leave it in the 401k once you're no longer contributing to it. Bill, I think you had something you wanted to tell about this.
Yeah. We've noticed when with some IRA accounts for some of our clients, they've taken out the money and have used it for different things. Even before the age of 59 and a half, you'll still be subject to income taxes, but you won't be subject to an early withdrawal penalty of 10% of what you withdraw. And some of these things you can use it for and take distributions out of the IRA would be like one, to pay for qualified higher education expenses for yourself or your spouse or child or grandchild. Or another one that we've seen is first-time home purchases. People need to have a down payment. They may not have it available, and so they take it out of the IRA, and again, they'll be subject to the income tax, but they're not subject to a 10% penalty for early withdrawal on that. So we have seen it in different instances, since the money is in an IRA.
Right. So they can't make that withdrawal from the 401k. And we're not advocating withdrawing from any retirement account, but circumstances do arise, and you have more flexibility with the IRA. Anyone want to add to this?
My comment would be you have to be a little bit aware of if you take money out of your company plan, there are quite a few investment people out there that would like to do rollovers. And the reason they would like to do rollovers, if they're commission-based, is they're going to receive a 6 to 9% commission when you roll over, whatever it is, $100,000 to A shares or B shares or any type, or sometimes to an annuity. So that balance is those expenses, although it might not come out of your money, it does part of the expenses of the fund. If you go to a fee-based planner, they're going to charge you for management 1% of the first $500,000, and then above that it's going to go less, or above $1 million it's going to go less. So there's no really front charge for the rollover, and the fee-based planner is going to be with you for a long period of time. So I would be leery of doing rollovers to commission-based financial services personnel.
Right. And you do hear a lot of ads on the radio for rolling over your 401k. Mistake number 10, thinking someone at your company is watching over your account. Dan, what's your take on this?
Well, we've seen this before from employees that work for both large and small companies, thinking that someone at their company was watching over their account. Years ago, when defined benefit plans were more plentiful, someone at the company was actually managing the money on their behalf. But for 401k plans and IRAs, they fall under the term self-directed, which means that the employee is ultimately going to be responsible for making every decision regarding that welfare, the maintenance, and performance of their investment account. Employees also, they often don't understand that the company really isn't there. Your company will provide you with the framework for your retirement plan. They will provide you with investment choices, and they'll forward the money they deduct from your paycheck to the investment company, but that's where the responsibility ends. The rest is going to be up to you. I think the important thing to understand is that your 401k is like an account you would hold at a discount broker. Every decision that you make regarding that investment is going to be up to you, so you need to act accordingly. Anyone have anything to add to this?
If you're an employee at a company, you need to be assertive to whomever the representative is of the company. It's just the way it is. If you're not assertive, you're not going to get any attention. But you need to be assertive to find out your options. Okay.
Mistake number 11, investing in high commission-based investments. We've touched on this some, but Raj is going to describe this for us.
Yes, thanks, Kathy. Before I start to talk about this mistake, I'd like to define investment advisor and broker, because I'll be touching these two terms in this mistake. Investment advisor is a fiduciary who's legally responsible to act in the best interest of an investor, and a broker is someone who just acts as a middleman and focuses only on his or her commissions from the investment that you make. So The mistake itself says investing in high commission-based investments. And we all know there are many, many thousands of investments alternatives that we have when we want to make an investment. So what kind of investment should we not invest into, and what are those high commission-based investments? I will briefly touch into each of them. I have noted down 5 of them here. So the first one is equity indexed annuities. We should avoid these because the commissions on these range between 10 to 12%. So if you are investing $250,000, the broker itself gets like $25,000 to $30,000 from it. So the second one we have is the loaded mutual funds. These funds have a commission, or we can say back-end fees of usually 5% or more. These funds are good, but the problem with these investments is if you buy them from a broker, you don't get any advice after you make the purchase. But if you have an investment advisor, he can look into it. And the third type of investment that we want to make our listeners aware of is the high expense mutual funds. These are funds that have annual expenses over 2%. So if you add in the trading cost, you might be spending more than 2.5%. So based on the same number, $250,000, you are selling out $6,250 per year. The next investment that we want to make our listeners aware of is expensive fee-based advice. Like we discussed this before, you have to pay your broker's firm, investment managers, the trading costs. So the higher the fees are, the higher it will be for your portfolio to survive. Finally, the last one that I have written down is variable annuities loaded with guarantees. I believe Paul has a better example for this, but before I transfer to him, I'd like to quote a very good quote from Arthur Levitt, who was a former SEC chairman. What he said is, "You should fire your broker and find an investment advisor." Brokerage firms would like to think that they perform the same functions as investment advisors. Many brokers call themselves financial consultants or financial advisors, but they are not the same as independent investment advisors. An investment advisor's fiduciary duty is on a higher plane, like that of a lawyer, a trustee, or the executor of an estate. With that, I would like to have Paul add some comments on this.
Regarding number 11, I mean, we certainly don't want to come off at a situation where we're not, where commission-based investments are not appropriate. They are appropriate. Annuities in given circumstances are appropriate. Variable annuities with guarantees are appropriate in given circumstances. Some of the mutual funds in their costs are appropriate. Even though the costs are higher, it is appropriate. There was a fund called the Legg Mason Value Trust, which had a very high expense ratio, but they paid the fund manager more than normal. He beat the S&P 15 years. He's fallen on bad times now. But the point is these investments, they are appropriate in given circumstances, without a doubt. The problem we see is some of these are appropriate in 1 out of 20 situations, and when they finish with the financial advisor, the amounts are recommended in situations that are not appropriate. And that's where you get into the human nature of the compensation, being that the advisor is selling something because of the compensation, not because he's looking out for the welfare of his client. And those are the situations you want to avoid.
Okay, mistake number 12 is not learning from the history of the market. So your missing word is history. have you ever seen the magazine headline of the best performing mutual fund of the year? It's out in January or February each year. But it's funny that same mutual fund is not the winner the next year or even the next. Markets are unpredictable, but we do learn some things from the history of the market. Some asset classes, and we've touched on this some before, some asset classes do well during periods of inflation, and others do well when inflation falls. You want to have as many asset classes as possible so that whatever is going on in what will soon be history does not cause your portfolio to fail. You may be familiar with the principle that when bonds are up, stocks are down, and vice versa. Well, classes like commodities have their best performing circumstances too. And your portfolio should be diversified enough to be stable during the worst of times. Most cycles in the market last a long time. For instance, 1982 to 2000, that was 18 years of a bull market where, stocks did well most of that period. Don't be deceived by predictions that this time is different. There may be elements that look different, but the patterns repeat over and over again. Sometimes it's cheap to get into the market, and sometimes it's expensive to get into the market. This is, that ties in with the rearview mirror idea. It ties in with asset allocation. All of these things are important in your portfolio. And Paul mentioned that, when you don't have a lot invested, it's hard to have much diversification. But your goal, and when you have that written statement of what you want to accomplish, that would be one of the accomplishments, would be to increase the number of asset classes that your portfolio can have managed. Any comments from the panel? Okay, we'll move on to number 13, not exploring the alternatives for inexpensive, diversified investing. We hope by now that you see the value in investing in various asset classes and making sure that your 401k is diverse. No more buying a growth fund and leaving it there for years. A wonderful goal is to have a good average return with limited risk. Asset allocation is key to providing a return that is as consistent as is possible related to the risk that you're willing to take. This is a very individual matter, and you should be sure your advisor explores your risk tolerance. So what's the reward for diversification with limited risk? Let me try to give you an example over the phone here. Suppose that there are two portfolios. Portfolio A has a return of 40% in the first year, it's down 20% in the second, and it's up 10% in the third. If you started with $100,000, this would mean that after year 2, you would have $140,000. It had a return of 40%. It lost 20% of that in the second year, which would bring it down to $112,000. And then the third year, it had a gain of 10%, so the balance ends up being $123,200. So that's an overall gain of 23% over the 3 years. If you take the same amount of money, the $100,000, and you were actually able to have a 10% gain each year, after those 3 years, you would have $133,100, which is an overall gain of 33%. Over time, the lower volatility can create huge differences in portfolio values. And this is a simplified example because it would depend on when you bought and when you sold, but the principle is correct. So can you have a lot of diversity and keep down the cost of the funds? Yes, of course you can. Many fee-based advisors use only no-load mutual funds or electronically traded funds. These are what we use. They have very low expenses, so even with the management fee, you are still paying less. And this helps your returns, and you can actually see what the management fee is providing if you're working with an advisor who is involved in your overall financial picture. Any comments?
What she's saying is that, like in 2008, if you had an account for $100,000 and you were in the S&P, you went down 40%. The following year, the S&P was 23%, but you get 23% of the 60. So in the following year, the S&P was 15, but you only get your balance in the account. So if you limit your down years, your return is going to be more because it's the return you get is going to be based on your balance, and if it's lower, and if you do allocation, it's going to limit the down years. In looking at number 13, I would tell you that our most successful clients allocate according to their risk tolerance, and their risk tolerance is the amount of risk they want to take and are comfortable with in their account, and they have an open discussion with their financial advisors. They also invest something above zero monthly. It doesn't matter what it is. You can be in any financial situation you might have. Many people can save $100, $200, $300, $400 a month. It's a car payment. And we tell people that they should do that in their personal bank account so that savings is part of their monthly living. And with regard to number 13, it's always the same. It's the people that take big risks can have stock losses, but we advocate the rule of slow and steady wins the race.
Okay. That brings us to the end, Jeff, if you want to move forward with the conference.
Thanks, Kathy. And if you're listening right now and you have a question, we'd like for you to just press *2. That's *2 on your phone. That will raise your hand, and we can open up your phone line to ask that question. And Kathy and Paul, as we wait for some questions to come in, we want to mention you're offering two, options or solutions that people can take advantage of if after they've listened to this and they want someone to take maybe an objective look at their investments, see if they're making any mistakes, or even just let them know if they're on the right track. The two offers are what we call a financial health assessment. One is for individuals, and we're on page 2 of your note sheet if you're following along on the call. And the FHA, or the Financial Health Assessment for Individuals, is where Sullivan will evaluate your existing retirement plan, any investment accounts, life insurance coverages, long-term care and disability coverage, and education funding, and just kind of give you an assessment of what you're doing either right or wrong. The initial consultation, it's normally $625, but if you schedule it before December 31st, 2011, it's going to be free or complimentary. For business owners, the FHA, or Financial Health Assessment, is a little bit different. Sullivan will evaluate all the items listed in the FHA for individuals, but in addition, if it's applicable to your business, they're going to look at and evaluate your company retirement plan, any succession planning, including buy-sell agreements, any employee benefits that you're offered, and even look at the structure of your organization. Again, the initial consultation, normally it's a $625 fee because there's a lot of work involved, but if you schedule that before December 31st, 2011, it's going to be free. So we want to make those available to everybody, and contact Paul or Kathy if they have an interest in that. And our first question is going to come from Berman Property, I think, and I've opened up the line. Go ahead and state your question.
Yes. Is this private, or is everybody listening?
Everybody's listening. You can call me later if you want.
Yeah, I think it would be better.
Okay.
What number can I call you on?
Just a regular, number, our main number.
All right.
Okay.
Go ahead.
That's the best question I've ever heard.
Paul and Kathy, a few other questions have come through the webcast, and let me go ahead and read these. Dan mentioned risk tolerance. Can you explain to me what risk tolerance means?
Well, it's the amount of the amount of risk that you're willing to, or the amount of monies you're willing to lose, or in your investments. Where are you comfortable? And not only just loss, but maybe in the form of growth, based on your comfortableness with your investments.
So, Dan, would that be maybe a percentage that somebody is willing to lose before they they say stop or get out of an investment. Is that how you kind of define it?
Right. Yes. Where do you say where do you say stop? Where do you say maybe we need to make a change? Maybe we need to sell this asset and move forward.
Yeah, and that's why doing the risk tolerance at the beginning is so important. We've seen people who, invested and they were, happy, and when the market was poor, they they want to sell everything. And so doing the risk tolerance is a way of avoiding that from happening. Some people are very comfortable with ups and downs, and some people are very uncomfortable. And so, we work with you to determine how much risk you're willing to withstand in order to have a chance at a higher return. So we're not recommending that if you have lots of nerve, you should risk all on junk bonds, but rather that your range of investments can be greater than those who are not tolerant. That help?
That helps a lot. I think that answered their question. And I've also gone ahead and opened up the line, so if you do have a question, you can just go ahead and say it out loud. We've got another one, Kathy, from the Internet. Can you explain the difference between fee-based and commission investment firms?
Sure. A fee-based advisor charges you a percentage of your portfolio annually to manage your accounts. A good fee-based advisor will also buy investments that have low expenses tied to them. Commission-based advisor does not charge you a fee, typically, directly, but he provides you with mutual funds that collect fees from you and pay to him before you receive your earnings. And the total amount of these fees is typically higher than the fee-based model. In case you're paying for management and service, in either case, you're paying for management and service. So the question is, what does it cost to hire this advisor as compared to hiring another advisor?
Is the way to determine that just a straightforward question to whoever your advisor is, just ask he or she how they're compensated?
It is, but you need to be a little bit more assertive about it, because in the commission-based world, with all those different types of fees, they don't want to confuse you, and they don't want to prolong the discussion either, I suppose. So you need to make sure that they're covering all the fees, and also make sure that you look at the prospectus, because the prospectus does divulge all of the fees.
Okay, that makes sense.
My experience is you have to be very assertive.
And very assertive, Paul, is not only the prospectus, but also just...
It's hard to find it in the prospectus.
Is it?
Somebody,
okay.
You need to be educated. It's very difficult. Somebody has to explain it to you in English.
Gotcha. That makes sense. Paul, we've got one more coming through the Internet. And it is, how do we know if our pension plan is being handled appropriately?
The way to do it is you get it reviewed. And when we do a review, the minimum that people are going to get, the company is going to get, is they're going to get and it's possible that when Kathy reviews it, we're going to tell them that it's being handled appropriately, the cost is correct, they should stay with those people, they're doing a good job. And that, when you have that review, it doesn't, at least when we do it, it actually provides something, I believe. It doesn't really cost anything.
That's right. So I think,
whether it's us or someone else, but it.
Right. Yeah. So the answer, this is aimed more at the business owner. On the employee side, we'll do the same thing, but your options for correcting, if it's not a wonderful plan, your options for correcting are somewhat limited.
Okay, that makes sense. That clarifies it. Paul, Kathy, anything else that you want to add, or Dan, Bill, or Raj, to what we've talked about today?
Yeah. For those people in the audience, they can Google top 13 mistakes by retirement plan investors, and it'll come up. It's the pamphlet was written, a collaborative effort by our CPA group and the Archer funds, and it has most of the information, if you don't have it already, that we've talked about today.
And we certainly appreciate everybody's time. Thanks for being with us.
Paul, I'll go ahead right before we wrap up. It's just a little bit, I think we've got a couple more minutes. I'll mention the FHA offers again, and very quickly, what's the best number to either call you at there at the office or get a hold of Kathy?
The person to call is Kathy at 301-657-8080, extension 135.
That's right.
Okay.
Mm-hmm.
And Kathy, your email address is kgrow@esullivan.net?
That's right.
Okay. And again, the two offers are a financial health assessment for individuals, where if you just want somebody to take a look at what you're doing, see if you're making mistakes, Sullivan will evaluate your existing retirement plan, investment accounts, life insurance coverage, long care and disability coverage, and even your education funding. And again, the initial consultation is free if scheduled before December 31st, 2011. And the FHA for business owners is all of what I just mentioned, plus, if it's applicable to your business, Sullivan & Company will evaluate your company retirement plan, any succession planning, including any buy-sell agreements that you have, and the employee benefits that you offer, and even the structure of your organization. And again, normally it's $625, but it's free if scheduled before December 31st, 2011. Paul, Kathy, Dan, Bill, Raj, thank you very much. This is great information. Whether you're listening to this live or on the replay, if you do have a question, you can contact Kathy. Kathy's direct number is 240-316-3564, or the Sullivan & Company main phone line is 301-657-8080. Thank you again for being on the call. We appreciate your time today, and we hope to talk to you soon.
Thank you, Jeff.
All right. Bye-bye.